Okay, welcome to another edition of performance management. In today's class, welcome to another edition of performance management. In today's class, we shall continue with absorption costing. Now, let me quickly do a brief recap here on absorption costing. In our last class, I said absorption costing is a costing techniques, right, that charge variable cost per unit and a fixed cost per unit to its product, right? And on that, absorption costing is a full cost. It value its inventory using the what? The full cost, which is the variable cost as well as what the fixed cost per unit, or you can say the fixed cost per unit can be your OAR, which is overhead absorption rate. And I explained that overhead absorption is allocation of a cost to a particular production unit, right? You are allocating a cost. That is, that cost, whether you produce or you don't produce, you will incur that cost. Is that not so? That is the overhead absorption rate, which is what known as what? Either you can call it OAR or predetermined rate. I equally explained in our last class that company has different basis of absorbing their overhead, basis of charging overhead to a particular production. That is what it means. Companies have different overhead basis of absorption. That is what will take us to basis of absorption. Now, an organization can absorb their overhead on the basis of units, projected units. It could be on machine hours, it could be on labor hours, it could be on percentage of prime cost or direct material, percentage of direct material, depending on what the company basis of absorption, right? We have equally established under and over absorption, right? Which gives most students headache, right? Now, what will you use to calculate the overhead absorption rate? Let's pick it from there. What will you use? I equally stated in our last class that overhead absorption rate or predetermined rate, right, or predetermined rate or fixed cost per unit is calculated as budgeted fixed production overhead divided by your budgeted level of activity, right? And this budgeted level of activity could be labor hours, could be machine hours, could be percentage of prime cost, it depends on the company basis of absorption, right? And this will now take us to where? Over and under absorption. I told you in our last class that don't worry about your over and under absorption. You will understand it when we start the format of absorption costing. Now, your over absorption means that the overhead absorbed, when an overhead absorbed is higher than the actual cost, it becomes an over absorption. So what will you do? You charge the overhead absorption. If you have over absorption, you charge it to your gross profit. You add it with your gross profit. That is the treatment, right? Then when your overhead absorb is less than the actual cost, actual overhead, right? Actual overhead, right? You treat it as what? Under absorption. And this is treated as an expenses. Now, you will appreciate this more when we get to variance analysis, right? But you will have an understanding of why is it over and why is it under when we start the format of absorption costing. Class, am I communicating, please? Class, are we still together, please? Hello?
Yes, sir. We are together.
Yes, sir. Yes, sir.
Okay. Now, if that is established, we've talked about the over and under absorption. Then we'll talk about the treatment of under or over absorption. You can see the advantages of, don't forget that absorption costing is a traditional costing system, or a conventional. Don't forget this. It's a conventional system. It is a traditional system. And we equally state an example in our last class. I think I've forgotten the name of that. I think I follow in short thereabout. When I stated an example that the reason why it is a traditional approach is because you have a 4 bedroom flat, right? Or 4 units. Different people occupy that particular what apartment, and then I bring what is it called, water bill of 40,000 naira. You guys now say, oh, let's divide it by the numbers of units, by the numbers of flats that we have, divided by 4. Then we will now share it equally. That is cheating. This is what absorption costing is doing. It is cheating, because I may not be at home for the whole month, right? And you will still tell me that we will share it equally. Why can't we share it based on consumption? Right? We will get there. That is what activity-based costing try to correct absorption costing, because absorption costing accumulates the cost that, oh, let's share it equally, right? That is why it is called traditional approach, right? Now, we equally have the advantages and disadvantages of this. You can see it complies with SARS and IAS2 on inventory valuation. You can see it, and it's also it's also emphasized on the importance of fixed costs and thereabout. You can see the advantages of absorption costing, right? Now, it leads to over, that is one of the over and under absorption. It can be used, it does not help in short-term decision making. Now, class, our focus, we already know that it deals with under and over absorption, right? Now, the major differences between marginal costing and absorption costing is the differences in the valuation. Marginal costing value its inventory using variable cost. Absorption costing value its inventory, both fixed cost and what? And variable cost. Is that also? Now, in marginal costing, you can have the profit, the decision. You can say the decision is based on contribution, right? Is based on what? Contribution. Why under the absorption costing, the decision is based on the what? The profit make, right? Now, the format that will bring for us, the format that we will use for absorption costing will be based on the normal profit or loss format, right? Right? With it is suitable for profit or loss format, right? And that is what we will use, right? In accordance with IS1, we will see the way we plot everything, right? And that is my explanation on absorption costing, right? The only part I have not explained is the over and under. I only mentioned that over means that when your overhead absorbed is greater than the actual overhead, that is an over absorption, and it will be treated as what? And it will be added to your gross profit, right? Why your when you have an under absorption, whereby the overhead absorbed is less than the actual overhead, you could say this is under absorption. And I will equally justify that when we start the format of what? Absorption. Class, are we still together? Are we still together? So we can see the major differences here. Are we still together, class?
Yeah.
Now, let me use, okay, let's do it after this. Are we still together, class? Okay, okay, let's quickly have the format for the absorption costing. Now, we will still, just the way we did, marginal costing, right? We will assume that the question says that you should prepare for 2 months or for 2 years. Okay, we can use years now. We can use 2 years, right? We can use year one and year two. That is, you have to prepare absorption costing for 2 years, which is year one and year two. And that is what we'll be looking at, class. Okay, let me quickly copy the other formats from these parts, what we need. Okay, let me just copy these parts. I will clean some of them. Okay. Okay. So we'll quickly change this. We'll quickly change this to absorption costing, right? We'll quickly change this to absorption, absorption costing, and it is full cost. It is what, class? It is what? Full cost. Put it as full cost, right? Then let's assume it is year one and year two, year one, and as well as what? Year two, right? Year two, year two, class. Now, if that is established, you will still, in every question, you will still be given sometimes your selling price per unit, right? The selling price per unit times the sales unit. Sometimes you may be given the sales directly, right? Excuse me. So if this is established, so if this is established, right? So what we will have here is your cost of sales. Don't forget that I said we will use the format of profit or loss account, right? So what we have here is of variable production cost, right? We will equally have cost of sales, right? Cost of sales, right? Now, instead of having class, are we still together? So instead of having your direct material cost, your variable production overhead cost this way, we will tend to modify it in absorption costing, right? Now, what you need to do is that we will just, after your opening inventory, now let's start with the opening inventory. So that will be we already know how to determine opening inventory. Is that not so? We already know how to determination of opening as well as what? Determination of closing inventory, right? We will not establish that here because we've done that in what? In marginal costing. But the only thing is that we will do is the valuation of that opening inventory, right? So how will you value it? You value it at full cost. At what, class? At full cost. Now, I will not bring out the opening, determination of opening and closing inventory here, right? I will not put it again. So use the total variable costs, right? Total variable costs, total variable costs per unit. Use the variable costs. Okay, let's use okay, variable costs, variable costs plus variable costs plus coming variable costs plus fixed costs per unit, right? Okay, class, are we still together, please? Now, use variable costs per unit. Let's say total variable cost per unit. Let me put it there so that total variable cost, so that you will see it as total variable cost. Use total variable cost per unit plus your fixed cost per unit, class, because, okay, please, can you see my screen? Please confirm if you can see my screen, or let me actually increase the size. Okay, please, can you see it now? Can you see it very well? Please confirm. Can you see it? Are we good?
Yes.
Okay,
Yeah,
okay.
yeah,
Now
yeah.
you see it. Okay, thank you. Now you can see here that opening inventory, we will not do determination of opening or closing inventory here because we have actually done that in marginal costing, right? Now, the only thing we will do is the addition of use total variable cost per unit, total variable cost. Let me quickly indicate, because if not, we'll go and use the total variable cost instead of total variable cost per unit. Yes, you can see it on my screen. Total variable cost per unit, total variable cost per unit, right? Then plus you add the fixed cost, you add the what? You add the fixed cost, you add the fixed cost plus your fixed cost per unit, which is your OAR. Your fixed cost per unit is your OAR class. Your fixed cost per unit is your OAR, is your predetermined rate. We will determine that now, class. That is your first step, right? You need to determine the total variable cost per unit as well as what? The fixed cost per unit. That will be your first step. Now, I will go down now and say step one, class. I will say step what? Step one, class. Are we still together? Then I will go down and say step one, step one. So we have determination of full cost per unit, class. So we assume that we have marginal costing, MC, which is the marginal costing, then absorption costing, which is AB. Please don't use AB and MCO in exam. I take God beg you, please. Now the next one is under the marginal costing. Maybe you have direct, you can have direct material, right? Direct material per unit, right? So you put it here under this side. Okay, direct material per unit, right? Or, okay, let me use, okay, don't let me use this. Come. Okay, now direct material, we want to determine the full cost, right? That we will use to value our inventory, class, right? Now, direct material per unit, per what? Per unit. You put it here, right? So you can have direct labor, right? Direct labor per unit as well, class, right? You put it there. Then you can equally have variable production overhead, right? As your variable cost, variable production overhead, right? Overhead. Now, don't forget that variable selling is not part of your production cost. Oh. Even under the absorption costing, you will not bring it as part of your variable cost because it is not part of your production, class. Now, variable production. Now, if this is all you have for variable cost, is that not so? Now, what about the fixed cost? So you can now have fixed cost per unit. You can now add your fixed cost per unit, or you say it is OAR. OAR means overhead absorption rate. Now, we will now determine overhead absorption rate now, class. So when you add all these things together, you have your what? You have your full cost per what? Per unit. You can see that you have your production full cost, production determination of full cost per unit. You can see that it is combination of both variable cost per unit as well as what? Fixed cost per unit. And this is what you will use to value your what? To value your inventory, as well as this is what you will equally charge to your production, right? And this one you can have your fixed cost per unit. This is what you will charge to your production as your what? That's your full cost. And this is what you will still use to what? To value your what? To value your inventory. Now, let's quickly now do step 2 to work out your overhead absorption rate. Let's say work, okay? Let's say step 2, right? Determination of OAR slash fixed cost per unit, right? Determination of OAR. Don't forget that another name for OAR, overhead absorption rate, or fixed cost per unit, or predetermined what? Predetermined rate, right? Now, if this is established, so how will you determine? The steps is actually on the material. If you check inside the material, you see how to determine overhead absorbed. Is that also determination of overhead absorption rate? How will you determine your overhead absorption rate? Now, it is calculated as budgeted. I've done that before. Budgeted, fixed. Then it is projected fixed production overhead, right? Or fixed production cost or fixed production overhead divided by budgeted 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 level of activity. Don't forget that I said activity could be, it depends on the company's, you need to watch out for company's basis of absorption. That is what you will need to watch out. Is it based on labor hours, right? Is it based on labor hours? You check from your question. Is it based on labor hours, right? Or is based on machine hours, right? Or it could be units produced, right? Budgeted units, right? And unit produced, budgeted unit produced, right? And that is it. So you observe from your question, and with this will give you your what? OAR, which is what? Overhead absorption rate. And once you get your overhead absorption rate, you quickly add it, you quickly include it in valuation of your inventory. You add it together as your what? It's your full cost. Class, are we still together? Now, if this is established, right, don't forget that we're talking about the valuation. Is that not so? And you see, I say use total variable cost per unit plus your fixed cost per unit to multiply the inventory unit. You can see by then you have already determined your opening as well as what? As well as a closing inventory, of which we have established that under the marginal what? Under the marginal costing. Now, the another difference is that instead of you having direct material cost, direct labor as your production cost, right? You will accumulate everything. We've already added everything, so you don't need all this again, right? So let me show you what you will do. You don't need all these parts. So these parts, you don't need this part again, right? So we can have just a minute. Let me arrange this. Okay. Now, you don't need this, right? What you need here is your production cost, production production cost. Now, what is the production cost? Your production cost is you are charging, don't forget that you are charging the full cost to production. You are charging what? Full cost to production. What are these full costs? Is your variable cost per unit and your fixed cost per unit, addition of these two. So you don't need to put direct material, direct this, blah, blah, blah. No, you don't need that. Just put your full cost, multiply your full cost times the unit produced, class. Multiply the full cost. Use full cost per unit, right? Times to multiply times the unit produced. Use what? Use full cost per unit, right? So when you use full cost per unit, sorry, okay. So use full cost per unit, right? Okay. Now use full cost per unit to multiply your unit produced. For instance, you produce 50 units, for instance. So what you need to do is that to get your production cost, you multiply the full cost, which we have already calculated the full cost already, right? Right? Your full cost, check work one or step one. Your full cost is the combination. I've been saying this now. Your full cost per unit is the combination of variable cost per unit and fixed cost per unit. How do you determine the fixed cost per unit? You use OAR, overhead absorption rate, of which we have determined that in our steps. Class, are we still together? Listen, I need to confirm that. Are we still together? Hello?
Yes,
Yes,
yes, sir.
yes, sir.
Yes, sir. Okay, that's fine. Now, if that is established, when you want to determine your closing inventory, we already know how to determine closing inventory under the marginal costing. Please, if you have not watched that video, go back and know it's very simple how to determine opening and closing inventory. Very simple, right? So, if you want to value your inventory equally as well, you use full cost. What is the full cost? Is your variable cost per unit and your what? Your fixed cost, of which we will determine that, right, in the steps, right? Now, what you need to do now, you can see it in the steps, right? This is it. Let me show you again. You can see the step one. You can see the full cost, right? You can see the full cost, right? Now, you can see, so how do you determine your OAR? You can see the steps to determine the what? The OAR, which is the fixed cost per unit. So the same thing applicable here. Then you multiply, right? You multiply. Let me copy all what is in that side and paste here. Okay, right? Okay. Now you can see it now, and this is okay. Use You can see it now. Use the total variable cost per unit plus the fixed cost per unit to multiply the what? The inventory, which is the what? The closing inventory. Class, the closing what? The closing inventory. Now, in this case now, in this case, after you have now let me put something here. Okay, let me put something here. You can see that your opening inventory class, your opening inventory, I just want you to understand PM because PM is very simple, right? I don't know why people say, oh, it's not difficult. You can see the way we are moving, right? And that is how you see if you understand the way we start. When we get to absorption, when we get to what is it called? CVP, all these ones cannot even we can just use only one class for CVP, or we can use two classes for CVP, one class for the single product, another class for the multiple product, then we move on, right? Now, if you understand this thing from the beginning, you will not have any issue in performance management or in management information because it's still the same thing, right? Now, use your full cost. Now, when you add the opening inventory plus the production cost, right? That is okay. You add the two together, you can have this, right? Or let's do it this way: your opening inventory plus your production cost, right? Plus your production cost, right? Minus your closing inventory. Minus your what? Your closing inventory. Let's do it that way. You can see it on my screen. Minus your closing inventory. Now, when you minus your your closing inventory, opening inventory, add production cost, less closing inventory. When you less closing inventory in your P&L account, in your profit and loss account, what do you have, class? When you less when you add your opening inventory, you add your purchases, you less your closing inventory. When you less your closing inventory, what will you have, class? When you less your closing inventory, what will you have? Hmm.
Cost,
Precious, you
cost
have
of
what?
goods sold.
You have the cost of goods sold, right? Which is still the same thing as cost of
Cost
sales.
of goods sold.
You have, oh yeah, that is cost of sales. Is that not so? Cost of goods sold. Is that not so? And that is why we put cost of, that is why we put, what is it called? That is why we have the cost of sales in that part. Is that not so? Now, if you've done this one, right, don't forget that you have your gross profits. When you remove your sales, the only time you will have your cost of goods sold or cost of sales is when you have your opening inventory, you add your production cost, you less your closing inventory. When you less your closing inventory, thank you for that, you have your cost of goods sold. Is that also or cost of sales, of which we have put it here? You can see cost of sales there. Now, deduct it from your sales. You have your what? When you deduct it from your sales, you have what in your P&L account? What do you have? When you deduct Your sales minus your cost of goods sold. What do you have,
Gross,
class? Gross what? Gross
gross
profit,
Gross
profit.
right?
profit.
That's right.
Thank you. Thank you. Here will now be gross profits, class. Here will now be what? Your gross profits. Here will now be what? Gross profits. You can see here will be what? Gross profits. Okay. Now, if that is established, the same thing applicable to year two as well, right? The same thing applicable to year two as well. Let me put this here. So, okay. Come in. Okay. So, it's from this side. Okay. Now, the same thing applicable to year two as well, right? You add them together, you subtract it from your closing. See, you add your opening inventory, add your production, less your closing inventory. That is what gives cost of sales or cost of goods sold. Now, if that is established, you remove it from your sales here. You can see your sales, right? Or you remove it from your sales, you have your gross profit. Now, the question is, you're supposed to ask that, oh, what about variable selling production overhead? Class, variable production selling overhead is a cost you incur, is an expenses you incur when you want to sell, when you want to make a sales, right? So therefore, the variable selling will be treated as an expenses under absorption costing. Why? Because absorption costing is like your normal profit or loss account. And when you want to make a sales now, you want to sell these goods now, and you incur a cost to it, where will you apportion that cost to? Where will you put that cost? It will automatically becomes your what? Your expenses. Is that not so? It will becomes your what? It will becomes your what? Your expenses. And that is what you will do for the variable selling production overhead cost. The variable selling production overhead cost class, when you see it in the question and they say you should prepare absorption costing, put it under where? Charge it to where? Charge it to charge it to your expenses. Is that not so? Take it to your expenses because it's an expenses you incurred in the process of selling. That is under absorption cost because absorption costing is allowed by the relevant tax authority. Although there will be a challenges in under and or under, they may actually disallow your under and over absorption, right? Now, and actual absorption costing as your normal profit or loss account, and when you are incurring variable selling production overhead, it is an expenses. Why? Because it is an expenses you incur in the process of selling that what goods, right? Now, you charge your full cost to only your production. You charge your full cost, and you use the full cost to value. What is the full cost? Full cost per unit to value your inventory. Class, are we still together? Now, if that is established, I'm coming back to variable selling. Now, if that is established, right? We will now move to over absorption. The main problem, over absorption, over absorption. So let me use over absorption as step step 3, right? Step 3. Excuse me. Now, if it is an over absorption, right? It means that your overhead absorbed is greater than the actual overhead. Then it becomes what? Over absorption. And what the law says is that you add it to your profit. You add it to your profit, which means it's like a gain to you. Now the question is that what is the rationale behind, what is the logic behind this over absorption? Now let's quickly go to step 3, right? So that we understand the reason why it is being added to what? To the what? To the gross profit. Now, step 3, right? Step 3. Step 3. Now, determination of over slash under absorption. Absorption, right? determination of over and under absorption. Let's say you can, it's 2 years, right? It's 2 years, right? Let me just use 1 year so that we can move on. You do the same thing for the second year, right? Anything you do in the first year, do the same thing in the second year. So now, we want to determine whether it is over or under. Please pay attention to this part. It's very, very important, right? Now, research shows that this part gives students a challenge, right? And if you don't understand it, if I explain and you feel, oh, I don't really get this part, you can cram it and move on. Probably later, you will understand why it is over or under absorption class. Now, if we talk about overhead absorbed and actual cost. Let's say actual actual fixed actual fixed production let me abbreviate this. Overhead. Please, anything you do for year one or for January, do the same thing for February. You need to test it because you have your over as well as what under absorption, right? Now, if for instance the actual fixed production overhead, right, for year one, they say, oh, this is the actual cost that we incur. Fixed production means that whether you produce or you don't produce, you will incur that cost. Now, this is the actual cost that we incur. Now, let's say the actual cost you incur here is 20 naira class. Now, this determination of over and under absorption now. Your overhead absorbed. Let's say, how will you determine your overhead absorbed? Overhead absorbed is calculated as overhead absorbed. I'm coming. Let me shift this. Okay. Your overhead absorbed is calculated as OAR. You multiply your OAR times the unit produced, actual unit produced, actual units produced. That will give you your overhead absorbed. Now, if you check the material, it's there. How to determine over and under absorption is there. Now, why do we have to do it this way, class? Ideally, you're supposed to say actual fixed production overhead minus your budgeted. Your overhead absorbed is just like your budgeted overhead. And you say, oh, what is the difference? Is it over and under absorption? But no, you can't compare Ibrahim and Afolarunsho together. You can't compare both of us together until we have something in common. Class, please get this logic here. You can't compare Afolarunsho and IB together because we don't have something in common. We must have something in common. You cannot say, because question will test you, right? Where you will have your actual fixed, especially in variance analysis, your actual fixed production overhead will be given as this. Your budgeted will be given as this. So you will be tempted to compare your actual and your budgeted, and that you miss it because actual did not have element of budgeted and budgeted did not have element of actual. You cannot compare Kai and Afolarunsho together because we don't have something in common. Now, do you know why we now multiply by the actual unit produced? Do you know why? It is because we want to pick something in common in actual fixed production overhead. Don't forget that your actual fixed production overhead will be originated from your production and thereabout, right? So that is why we want the budgeted to have element of actual. That is why you multiply it by the actual unit produced so that you cannot compare the actual fixed production as well as the overhead absorbed, which looks like your what? Your budgeted. Class, are we together? So you cannot compare both of them. So that is why you will have to multiply by the what? the actual unit produced. Now, if you calculated your O, you calculate your OER and you multiply by the unit produced, you have your overhead absorbed. Then let's say the overhead absorbed is, let's say, is 50, for instance. Now, this is this is over absorption. Class, this is over absorption. Class, what does this mean? This is the cost, right? Now, you are supposed to incur cost of 50 naira as your projected, as your budgeted. Then you incur 20 naira. Is that not so? Now, that is an over absorption. Now, the difference of 30 naira, right? The difference of 30 naira will be added to the gross profit. Why? Is it because they tell you that use 50 naira, you use 20 naira? The difference will be like an income to you because you did not use it. Class, it will be like an income to you because what? You did not use it. It becomes what? An income to you because you did not use that income. You did not use that cost. Because I told you that use 50 naira and you eventually use 20 naira as the cost. What is the difference? The difference is 30 naira. You see that 30 naira? Where will I put it? So it will be an additional cash flow to me because I did not spend it. Class, are we still together? So it is it is what? Over absorption, right? That is what? Over absorption. So now you pick the differences, which is what? Which is 30 naira, right? So you can unmute your mic and ask your question. Please, before we create another link. I think this is 60 minutes. Unmute your mic. Hello. Okay, 15 minutes. Class, are we together?
Yes.
Yeah.
Okay. Okay, that's fine. Now we move to, maybe you do your year two could be what is it called? Under absorption. Your year two could be what? Under absorption. But let's use you charge to, then over absorption, add to gross profits. You add it to gross profit, right? Now look at the treatment. Let's quickly go back to the treatment, right? The treatment. You can see your over absorption is a gain and should be added to the gross profit or deducted from the cost of anyone. Now you can see why it is a gain, right? Please, if someone asks you now, you can see why it is a gain. You can see that is what we do at Next Gen Professional Associate, right? We will teach you. It is not only to pass, we will teach you. You will pass your PM as well. Then you will still use it to impart knowledge to other people, especially when you are in a manufacturing firm, right? Mostly performance management is for decision making, right? Now, if this is established, right? Now let's check for under absorption. Let's check for under absorption. I'm just assuming all this. Let's say your year two. Let's say your year two now is, let me push this. So the under absorption is the opposite of over absorption. Let's say you have 50 here, then you have 20 here. Class, your overhead absorb is like your budgeted. Class, question will test you. Please, they will test you something like, they will use something to test you under the variance analysis. Your actual fixed production overhead will be given to you. Your budgeted will be given to you. So you will now look at it. Is it favorable variance or adverse variance? You can compare. No, you cannot compare those two together. Class, you must have something in common. The actual your budgeted must have element of actual. That is why in this overhead absorb, we multiply the actual unit produced because we want that budgeted to have element of actual. So if it has something in common, Therefore, you can compare Afolomusho and Ibrahim because we have something in common, right? We will get there. Now, if this is 30 naira as over absorption, right? Now, this will be an under absorption. Under absorption. What will you do? You subtract it or you add it to expenses or you subtract it from your gross profit. Then I will explain why it's like that. Why? Can someone explain why we have to add it to our expenses or we subtract it from the gross profit because it's an expenses? Can someone, based on the first explanation, can someone just try? Please unmute your mic. And the person will have gift, special gift. Hello. Okay, Uzoma.
Hello.
Okay,
So,
I'm
if
with
I
you.
get you correctly, you were asking why the 13 naira is under absorption, right? Or what?
Yes, thank you. Yes. Yes.
It's because the actual is greater than the overhead. That's why it is
Yes, we know.
under.
But what is the logic behind it? I want like a layman explanation. Why? 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 Okay, Lydia.
That's
Okay, I'm listening.
Okay,
Uzoma,
so
continue,
according to
please.
your explanation,
Okay, Lydia.
no,
can
Okay,
you
let
hear
her
me?
I'm
continue.
listening. No, no. Uzoma, just hold on.
According
Lydia.
to your explanation,
Yeah.
okay, to this Lydia.
Okay.
According to your explanation for the over absorption, you said the actual face production overhead is 20 naira and
Yeah.
the overhead absorbed is 15 naira. So it
Yeah.
means you are supposed to use 50 naira, but eventually you use your overhead is 20 naira. So it means you
Yeah.
use less than what you are
Yeah.
supposed to use. So
Exactly.
it's like a
Exactly.
gain to you. So that's why
Thank
we
you
are
so
adding.
much.
But for
Thank you
the
so much. God
under,
bless you. Mm.
you are supposed to use 20, then you use
Yeah.
50. So that is above, it has exceeded what you are supposed to use. So that's an
Thank you.
expenses to you,
Thank you. God
if I'm
bless you.
right.
Please, immediately after this class, just send me DM. I have special gift for you. Thank you. And that is all. I have special gift for you. Please send me DM, please. It's very important. Send me DM. Thank you. Thank you, Lydia. Thank, thank you, Lydia, for that beautiful explanation. And it is what it is, right? Now, your overhead absorbed is 20 naira, which is like your budgeted. Then your actual is 50, right? Now, the difference between the 50 and 20, which means that you have used above what we say you should use, right? With that, you treat it as an expenses. It becomes your expenses, right? And that is your under absorption. Treat it as what? As your what? As your under, or as your what? As your expenses. And it is what it is, right? So, if that is established, class, if that is established, we quickly move here. So, if you have over absorption for the 2 years, right? For the 2 years, you add it here, right? So then, okay, let me quickly create another link so that we can continue from here. But before that,